401k is a powerful defined contribution plan that can help you save and invest in retirement. You decide how much to contribute to your account and which investments to choose. The unintuitive name comes from the section of the Internal Revenue Code that governs the plans. In this video, we'll take a look at 401k plans and why it's so popular in the US. We'll also explore the types of 401k plans, procedure for contribution, investment withdrawal from the retirement plan. So sit back, relax, and get ready to learn. What is 401k? A 401k plan is a United States retirement and savings plan that enables you as an employee to contribute a portion of your salary or paycheck to a retirement fund that can be accessed by you if certain conditions are met. Contributions are made on a pre-tax basis, thereby reducing your taxable income. Tax benefits of 401k. According to the Internal Revenue Service, 401k has two tax advantages for you. Your contributions are deductible on the employer's federal income tax return to the extent that the contributions do not exceed the limits described in Section 404 of the Internal Revenue Code. There are two types of accounts available to you: a traditional 401k and a Roth 401k. The difference comes down to when you pay taxes on your contributions. Traditional 401k. Your contributions to a traditional 401k plan are taken out of your paycheck before income taxes are calculated. This means that your contributions help lower your taxable income immediately. Contributions are invested in mutual funds and other investments and grow in value over time. When you take money out of your traditional 401k in retirement, you pay ordinary income tax on the withdrawal. Roth 401k. With a Roth 401k, your contributions are deducted from your after-tax income. This means your contributions come from your pay after income taxes have been deducted. As a result, there is no tax deduction for the year of the contribution. When you withdraw money during retirement, though, you don't have to pay any additional taxes on your contribution or on the investment earning. Contributions to 401k. You will decide how much of your income to contribute to a 401k account every year, subject to IRS limits. When you start a new job, you elect to save a percentage of your annual salary, and you can adjust your contribution level up or down as often as the rules of the plan allow. You may halt contributions entirely at any time for any reason. Let's say your bi-monthly paycheck is $2,000, and you chose to contribute 5% of your annual salary in the company's traditional 401k plan. In this case, $100 would be deducted from each paycheck and deposited in your account. Your taxable income would be $1,900, assuming no other pre-tax deductions. If you opted for a Roth 401k, the $100 would be taken out of each paycheck after taxes. Contribution limits. The maximum amount that you or your employer can contribute to a 401k plan is adjusted periodically to take care of inflation, which is a metric that measures rising prices in an economy. For 2024, the annual limit on your contributions to a 401k is $23,000 per year if you are under age 50. However, if you are age 50 and over, you could make a $7,500 catch-up contribution. If your employer also contributes, or if you elect to make additional, non-deductible after-tax contributions to your traditional 401k account, there is a total employee and employer contribution amount for the year. In 2024, if you are under 50 years of age, your total employee-employer contributions cannot exceed $69,000 per year. If the catch-up contribution for those 50 and over was included, the limit was $76,500. Matching contributions. Some employers offer to match their employees' 401k contributions up to a certain percentage of their salary. One common approach involves an employer matching employee contributions dollar for dollar up to a total amount equal to 3% of their salary. Another popular formula is a 0.50 hours employer match for every dollar an employee contributes, up to a total of 5% of their salary. Investments of your 401k. You typically have multiple investment options in your 401k plan. The plan administrator provides participants with a selection of different mutual funds and index funds, and sometimes exchange-traded funds to choose from. You get to decide how much of your 401k balance to invest in different funds. You could opt to invest 70% of your balance in an equity index fund, 20% in a bond index fund, and 10% in a money market mutual fund, for example. Withdraw of funds from a 401k. Funds saved in a 401k are intended to provide you with income in retirement. IRS rules prevent you from withdrawing funds from a 401k without penalty until you reach age 59-12. With a few exceptions, early withdrawals before this age are subject to a tax penalty of 10% of the amount withdrawn, plus a 20% mandatory income tax withholding of the amount withdrawn from a traditional 401k. After you turn 59-12, you can choose to begin taking distributions from your account. You must begin withdrawing funds from your 401k at age 72 as required minimum distributions, commonly referred to as RMDs. How do 401k RMDs work? If you hold traditional 401ks, you are required to take RMDs. The amount of your RMDs is based on your age and the balance in your account. As the name suggests, an RMD is a minimum. You can withdraw as much as you wish from the account each year, either in one lump sum or in a series of staggered withdrawals. As noted above, RMDs from a traditional 401k are included in your taxable income. How to avoid 401k early withdrawal penalties. There are certain exceptions that allow you to take early withdrawals from your 401k and avoid the 10% early withdrawal tax penalty if you aren't yet age 59-12. Some of these include medical expenses that exceed 10% of your adjusted gross income, permanent disability, certain military service. If you leave your employer at age 55 or older, a qualified domestic retirement order, QDRO, issued as part of a divorce or court-approved separation, 401k loans. Some 401k plans let you borrow against your savings via a so-called 401k loan. It's possible to borrow up to $50,000 or 50% of your vested balance, whichever is less. You generally have 5 years to repay your loan, and you'll be charged interest and origination fees, although the interest goes back into your 401k. If you fail to pay back the loan after 5 years, the IRS considers it a distribution subject to taxes and that 10% tax penalty. If you leave your job or lose your job, the plan sponsor may require the employee to repay the outstanding balance immediately. And if you don't, the sponsor will report it to the IRS as a distribution. When you leave your job, when you leave a company where you've been employed and you have a 401k plan, you generally have 4 options. Withdraw the money. Withdrawing the money is usually a bad idea unless you urgently need the cash. The money will be taxable in the year it's withdrawn. You will be hit with the additional 10% early distribution tax unless you are over 59-12 permanently disabled or meet the other IRS criteria for an exception to the rule. Roll your 401k into an IRA. By moving the money into an IRA at a brokerage firm, a mutual fund company, or a bank, you can avoid immediate taxes and maintain the account's tax advantage status. Furthermore, you will be able to select from among a wider range of investment choices than with your employer's plan. Leave your 401k with the old employer. In many cases, employers will permit a departing employee to keep a 401k account in their old plan indefinitely, though the employee can't make any further contributions to it. This generally applies to accounts worth at least $5,000. In the case of smaller accounts, the employer may give the employee no choice but to move the money elsewhere. Move your 401k to a new employer. You can usually move your 401k balance to your new employer's plan. As with an IRA rollover, this maintains the account's tax-deferred status and avoids immediate taxes. Is it a good idea to take early withdrawals from your 401k? There are few advantages to taking an early withdrawal from a 401k plan. If you take withdrawals before age 59-12, you will face a 10% penalty in addition to any taxes you owe. However, some employers allow hardship withdrawals for sudden financial needs, such as medical costs, funeral costs, or buying a home. If you enjoy the video, give it a thumbs up and subscribe to our channel. Thanks for watching.